If you're thinking of selling your technology company, then this is a video you'll want to spend some time with, because we're going to demonstrate how to build a financial model that makes your acquirer's diligence easier and makes your exit process that much simpler. So by way of introduction, my name is David Rowett. I'm an engineer by training. I've got degrees from Waterloo and from UBC. I did my MBA at the Harvard Business School, and I've spent my entire career working with technology companies. I've worked with over 75 of them in the last 35 years as a various C-level officer, employee, consultant, what have you. Currently, I'm a partner with Strategic Exit Partners. Strategic Exit Partners is a boutique mergers and acquisitions advisory firm, and we only have one goal, and that's to help entrepreneurs and their angel investors structure and execute the optimum exit for their technology companies. And to help in that process, we have published a wealth of material on our blog at www.exits.partners/blog, all about the exit process and how to help entrepreneurs understand and manage that process better. So, first off, at the top, let's be clear about this. The exit process requires a lot of diligence. And before deciding to buy your technology company, a buyer will examine every aspect of your business in very great detail, and for two basic reasons. One, they want to know what they're buying, so they want to kick over every rock and find out everything that's good or bad about your company, which means that they're going to look at everything. But the second thing also is to establish what's the appropriate purchase price to pay for the company that they're acquiring. And both of these are important, and both of these can be managed by developing a proper financial model. Now, the due diligence process can be long and frustrating if you're not prepared. So getting a head start on this, the financial model and other aspects of your diligence will certainly relieve a lot of stress at the time you're trying to get an exit done in the minimum time possible. So your financial model is the key piece of your buyer's diligence and valuation. Bar everything else, the financial model is the key piece that tells the buyer 95% of what he's looking for in terms of the diligence on the company and the valuation. So the buyers must thoroughly understand all of the financial aspects of your company. And your valuation starts with your financial performance. It's true that companies will buy on strategic value, but they will start with the numbers first, and the strategic value is usually secondary. So a comprehensive, well-designed model will shorten the buyer's diligence. And the best way to develop one is to integrate all of the historical, the current budget, and future projections into one comprehensive financial model. It's big and it's complicated, but it will do the job if it's structured properly. The financial model must be comprehensive to include all of the important numbers, and it must be easy to follow to make it easier on the buyer to understand where the numbers are coming from. So let's look at the basic structure of a comprehensive financial model. Excuse me. It's typically a single Excel worksheet with many tabs, and it integrates the historical performance, the current budget, and future projections all in one large top-level tab. And this allows the buyer to easily do analysis on growth, profitability, and other trends to inform their valuation. The model will also include numerous additional tabs to support the main tab, which is the top-level worksheet, so that it can reconcile to the financial statements, excuse me, track actual performance against budget, and build projections from your key performance indicators. So everything flows in together. It's comprehensive, it's consistent, and it's reliable. So if we look at a standard simplified income statement, I'm sure you've all seen this type of format before. And a simplified income statement starts with revenue, subtracts your cost of goods to achieve a gross margin, categorizes all of your expenses into three basic buckets: sales and marketing, development, administration, subtracts those total expenses from the gross margin to achieve your net income before tax. And once you pay the government its fair share, then you're left with the net income after tax. Now, typically, everybody's income statement is a little bit different than this. This is a simplified format, but for purposes of illustrating how the financial model works, this is the kind of thing we want to look at. So here we have the master income statement tab. We talked about the fact that there's one master tab that brings all of the numbers together into the top level tab, which is the master income statement, structured as I showed you a couple of tabs before. So I've broken these into colors, excuse me, blue, green, and orange to distinguish between the historical, the budget, and the projections. Now, this simplified format presents the financial model, assuming you were a company at February of 2022. So the historical financial statements for years 20 and 21 are in blue. There's a column for each year, 20 and 21, that is patterned after the simplified income statement I showed you previously. And there's 1 month, January 22nd, of the budget period, which has already been complete. And so that particular column of January 22nd, the budget numbers have been replaced by the actual numbers. So the budget in green runs from February 22nd through to December of 23rd. So that's 23 months. And that's in order to give the buyer at least a 12 months view of the forward budget, no matter where in the budget cycle you are when you look at this particular document. Finally, the projected results, 2 columns for 2024 and 2025 in orange that give you the projected financial projections for the future. So the structure of the master income statement, as we mentioned, is a top level tab. It rolls up numbers from all of the other tabs in the model, which we'll talk about. And it presents in column format the historical, one column for each year, 2021, 23 columns for the budget versus actual, well, 24 if you start with January 22nd and go through to December 23rd, and the 1 year for each of the projected future financial statements projections, 2024, 2025. So what's the source of the financial data? Typically, your company will have an accounting system that is using QuickBooks or Great Plains or many others like that. They record the actual accounting data that is generated by your company as it goes about its business. And these financial models are sophisticated. They can create monthly and annual income statements. They can slice and dice the accounting data in many different ways. But importantly, all of that data can be summarized and exported into Excel. And that means the Excel data can be incorporated directly into the financial model. And what this does is it verifies that all of the historical numbers in the financial model come directly from the financial statements, so that you don't have to spend too much time worrying about the accuracy of the historical financial numbers, because they're coming right from the accounting system. So the master income statement, historical data. The annual historical year-end income statement data is copied from the accounting system, as we've talked about, into a separate tab for each year in the financial model. So if you've got 3 years of historicals, you'll have 3 tabs in your financial model, and the top level master income statement will pull the data from each one of those tabs to populate the rows and columns in the master income statement. When we turn to the budget, remember those were the 24 months of your current budget period. Now, there's a couple of ways that you can incorporate the budget into the financial model. You could have a separate budget model, and that could be copied into a separate budget tab in the financial model, or you could just do it the laborious way and just copy each of the numbers in your budget model directly into your master income statement. And that saves including 24 different additional tabs into the financial model. So it makes it a little easier to navigate if you can put all of the budget numbers directly into the financial model. You can do it that way, or as I said, you could insert the numbers directly into the master income statement. And the budget section is month by month, as I mentioned, in order that as the months roll over, you still have at least a 12-month forward look as to the budget that you're executing towards. So tracking your budget versus your actual performance, this is something that all companies need to do to make sure that they're on track. The buyers will want to see this happen as they're doing their due diligence. They want to see how the company is tracking to its budget. As I said, 12 months visibility going forward. And the way you do this is that as each month is completed, the actual results for that month from the accounting system form a new tab in the model. And then the results, the actual results are copied over and they replace the budgeted numbers for that month. So as you go on, each budget month is replaced as the month finishes with an actual month. And so you get a combination of your actual and projected for the current and the following year, at least 12 months into the future. Now to the last section of the master income statement, which are your projections. Those were the orange numbers in the tab that I showed you a couple of screens ago. This one, there's a lot of flexibility on how you put together your projections. At the basis of it, the future results are based on your growth and revenues and expenses. And there's no standard format. Every company can produce this in their own different way. But you'll probably need several additional tabs to calculate what you need to know to project your growth. For instance, the revenue growth could be done product by product, or it could be relative to a specific metric, like the number of salespeople you're intending to hire and their productivity. Or if you've done some acquisitions or planning on doing some, then incorporating the results of those acquisitions into the future projections is all part of the game. As far as the expenses go, then you'll be budgeting increases in expenses based on your growth in revenue. You'll need more expenses to service them. You may be embarking on a new development project, which would need to be included in your future projections. All kinds of different things like that are going to influence your projections going forward. But the important point is that you must be able to trace the top line numbers in the master income statement to the assumptions and the calculations that you make in each of the working level tabs. So again, the theme is that all of the numbers must reconcile. Anytime you find a number on the master income statement, you need to be able to trace it back either to its historical origins in the accounting system, or to a calculation based on assumptions going forward into the future. So once you've done this, you've filled in all of the green, the blue, and the orange rows and columns, your master income statement is complete. But you're not finished there in terms of your financial model. Once you've populated the master income statement with the historical and actual and projected financial results, you'll have a complete description of the company's financial position today, which is very useful for doing the diligence, the financial diligence on your company. But as good as it is for financial due diligence, the master income statement is not all that appropriate for the valuation of your company, because your acquirers value companies based not on the net income, but on a slightly different concept, EBITDA. And we're going to spend some time talking about that. So the EBITDA, those letters stand for earnings before interest, taxes, depreciation, amortization, and more recently, any of the non-cash items which are used by the accountants to adjust the income statement. The most famous of those being stock-based compensation, which is extremely important for technology companies because typically they're issuing options to their employees, and the cost of those options, even though there's no cash changing hands, the cost of those options are charged against the income statement. All of which makes it very confusing to figure out the actual cash flow generated by the business. And this is why the M&A business and the accounting professionals have come up with a new term of EBITDA, because it gives the acquirers a more accurate view of the cash flow generated by the business than the net income does, because of all the adjustments that are given to it to make it comply with generally accepted accounting principles. So acquirers will often calculate the valuation of the business based on a multiple of EBITDA rather than a price earnings multiple. And as we've talked about, the EBITDA eliminates the accounting adjustments for how the business is capitalized, taxed, or charged with non-cash items. And so it's a better view of the actual cash flow. And this is what acquirers need in order to do a valuation on the company. The EBITDA, however, must be normalized. The EBITDA before normalization is calculated from the income statement, as we talked about, by adding back the non-cash items, depreciation, amortization, interest, that type of thing. But the normalized EBITDA includes discretionary adjustments that to remove expenses that would not have occurred if the buyer was running the business. Now, what I mean by that is that virtually for every business that's out there that's founder, owner, and driven, or founder driven, there are expenses that creep their way into the financial statements that are more personal expenses than they are corporate expenses. I mean, this is a very common thing that, a business lunch, which isn't really about business, but more about lunch, that gets written off as a business expense, or the new 55-inch color TV for the boardroom, not all that useful for business, but still gets charged as a business expense. The buyers, want to see how much cash the business is actually generating without all of these things that owners do to supplement their income. And so normalizing the EBITDA means removing all of the one-off items or non-business expenses and non-recurring expenses. For instance, if you've got a major expenditure that's only ever going to occur once, then you wouldn't want to charge your normalized income, your EBITDA with that. and that would be removed as well. So in simple terms, you start with, to get to the normalized EBITDA, you start with the net income after tax, which we showed earlier in the simplified income statement format. Add back the income tax, interest, depreciation, amortization, and non-cash charges to give you the EBITDA before normalization. And then you make the adjustments to remove the owner expenses and the one-time events in order to get the normalized EBITDA. And that's the key number for the valuation of the company, is your normalized EBITDA, which shows the cash flow of the business as a standalone, as if the buyer was running it. So the buyer will value the company based on a multiple of normalized EBITDA. Each section of the income statement in the financial model will include EBITDA and normalized adjustments so that historical, budget, and projection sections are consistent in the presentation. This presentation greatly simplifies the detailed financial diligence that the acquirer will perform on your company, and it can shave weeks off the transition process and probably half the stress that you incur in getting the diligence done. One last point is if your income statement is in native currency, not US dollars, then make a duplicate tab and convert your native income to US dollars, because typically your buyers are going to be thinking about things in American dollars and want to see the numbers presented that way. The last thing you need to do is prepare some graphs. So the financial model must include a separate set of graphs, and typically there are two. They'll always be in bar format, as I'll show you, but typically you'll have an annual revenue with the historical and projections on the same tab, but in different colors to distinguish the past from the future. And if you're looking at different revenue sources, you'll have a different color for each one of them. Secondly, the normalized EBITDA, which will show the historical and projections on the same graph, and again, in different colors to separate a past performance from the future projections. And you may have additional graphs for key performance indicators. I haven't included any of them in this presentation, but they may be important to your business. So here are the bar graphs that you would typically see, one bar for each year, different colors for different years and different products. So by summary, a comprehensive financial model is the key document in your exit process. It makes the financial due diligence easier and quicker, and speeds up the exit process in general. And it's the primary input to determine the valuation of your company before you add on extra value for a strategic fit between the buyer and the seller. The financial model must include the historical financial statements, the current budget and actual performance, and future financial projections, all on a single tab for easy cross-reference and trend analysis. And all the numbers anywhere on the financial model must refer to actual financial data from your accounting system or from assumptions that you've made about the future performance of your company. So that's a lightning trip through the challenge of producing a financial model. Hopefully you found it useful, and I invite you to look at other modules in the Strategic Exits Partners blog for other interesting information that may be valuable to you as you plan and execute your exit. So thank you, and we'll catch you again soon on the website.